Welcome to another episode of Coffee with Alissa. Today, I'm going to be interviewing Yvonne Usero, Senior Commercial Sales Executive with Huntington Insurance. But today, we're going to be focusing on some different commercial products. Thanks for joining me today. How are you?
Doing well. Thank you very much for having me, Alissa.
So first question, what industries tend to require the most customized or non-standard commercial insurance solutions?
It's a great question. Well, I would say any industry that where an answer starts with, well, it depends, usually needs custom insurance. I mean, manufacturing, construction, energy, transportation, especially anything touching international trade, they don't really live in tidy insurance boxes. I mean, you've got global supply chains, contracts written by lawyers in 3 countries, and equipment that costs more than a house. So if your operations are boring, your insurance can be boring, but if they're not, you really don't want to shop it like it's a Costco run.
Makes sense. So how do underwriters approach pricing for highly specialized risks? So things like political instability, commodity volatility, cross-border logistics?
No, certainly. So underwriters are typically part data scientist, part detective, and part professional pessimist.
Yeah.
I mean, I really do. I say that and I mean it lovingly. Usually they're watching geopolitical risk, commodity prices, tariffs, but what really moves the needle is how prepared a company is. Diversification, contracts, contingency plans, financials. The better your story, the cleaner your data, the less they're going to assume the worst. In insurance, fewer assumptions usually mean better pricing. I should say in insurance, fewer assumptions usually mean better pricing.
So what innovations or new products are you seeing in the commercial insurance market?
Well, as opposed to say, 10, 15 years ago, insurance is getting way more strategic and way less boring. At least I think so. Excuse me. Cyber liability is probably the fastest moving space out there, not just breach response anymore. Now we're talking business interruption from ransomware, contingent system failures from vendors, real crisis response teams on day one. At the same time, we're seeing growth in trade credit, also called TCI, and political risk, and supply chain focused products. Insurance is evolving from a lot more than just replacing the building to now much more protecting the balance sheet.
So what are the most common blind spots that companies have when evaluating their commercial risk profile?
So, very good question as well. Most companies, they usually insure what they can see, and then they tend to skip what actually kills cash flow. Big blind spots, cyber exposure through vendors, wildly inaccurate business interruption values, and missing or misunderstood contingent business interruption coverage. Everybody thinks they have it until a supplier shuts down and the claim gets uncomfortable. Business interruption and contingent business interruption only work if they're built intentionally. Otherwise, they're just expensive hope.
Well, how have recent tariff changes affected the way that companies evaluate their commercial insurance needs?
Excellent question. Specifically, and especially in this day and age, tariffs have really moved insurance from the back office to the boardroom, I'd say. Suddenly, leaders are asking, what happens to our margins? What if customers can't pay? What if a supplier disappears overnight? That's why we're seeing a bigger focus on trade credit, political risk, and contract alignment. Companies realize that insurance isn't just protection, it's financial resilience at the end of the day.
And so what types of insurance products would help businesses mitigate risk associated with international trade disruptions?
Excellent question. I mean, think of it as layers. Trade credit, bare bones, protects your receivables. Political risk protects you when governments change the rules mid-game. Cargo handles the physical stuff, and contingent business interruption protects you when a supplier halfway around the world shuts down and your phone won't stop ringing. You may not need all of it, but you do need the right combination.
And so when tariffs fluctuate, what are the most common coverage gaps that companies discover a little too late?
The biggest one I'd say is margin erosion. Insurance doesn't magically fix your bad economics unless it's specifically designed to. So we also see outdated trade credit limits, incorrect business income values, as kind of mentioned before, and contracts that really don't line up with coverage. Insurance only really works when it mirrors how money actually flows and moves through the company.
So how do insurers assess geopolitical risk when underwriting policies tied to global supply chains?
Now, they don't predict the next headline. They stress test resilience. And what I mean by that is, okay, where do the goods originate? Where do they move? How concentrated are the suppliers? How fast can you pivot? Geopolitical underwriting is less about crystal balls and more about how ugly does it get before you're really in trouble.
What's the primary purpose of trade credit insurance, and which type of businesses benefit most from it?
Certainly. It's just plain and simple protecting your accounts receivable. If a customer doesn't pay because they can't or they won't pay, the policy responds. It's huge for manufacturers, distributors, and exporters, particularly when the customers get bigger and closer to your cash flow. It's also being used a lot in transportation and logistics these days. I tell clients it is essentially a seatbelt for growth. You don't plan to crash, but growth without protection, that's risky.
What type of triggers are typical for a claim under an accounts receivable or trade credit policy?
Usually two main ones. Protracted default, meaning they're not paying, and insolvency, meaning that they're done paying or they've gone bankrupt. Sometimes political events would trigger claims like currency restrictions. The biggest mistake is probably late reporting. Trade credit rewards people who pay attention, really.
All right, so I got to throw a fun one in here at the end. If someone wanted to insure themselves against being kidnapped by pirates, spies, or rogue billionaires, what would a kidnap and ransom policy actually cover, and what is the wildest misconception that you've heard about it?
I love it. Love the question because of Hollywood and everything that we see these days. But first of all, yes, that insurance exists. It does exist, and no, it doesn't encourage kidnapping. Hollywood kind of did us dirty with this one, but K&R covers ransom payments, negotiators, crisis response, and legal experts and legal guidance. The whole team you hope you never need, but absolutely want if things go sideways. The biggest misconception is that you really tell people that you have it. In reality, confidentiality is everything. Best kidnapping and ransom claim is the one that never happens.
For sure. Well, thank you for joining me today. Thank you for sharing your expertise with us. And to the audience, thank you for joining. We look forward to seeing you on another episode of Coffee with Alissa.
Thank you. Thanks, Alissa. See you soon.